A couple months ago, the 10-year minus 2-year U.S. Treasury yield curve inverted. And in recent weeks, we've also seen the 10-year minus 3-month Treasury yield spread also get close to inversion. You've probably heard of the yield curve before or seen people on TV talking about it, aka freaking out about it. So what is the Treasury yield curve? What does it tell us about the economy? And what happens to future stock returns in the months preceding and after a Treasury yield curve inversion? In this video, we're going to talk about it.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
In a couple minutes, I'll get to a few specific things you should or could do to prepare for the potential ramifications of a yield curve inversion and a potential recession. But first, let's talk about what exactly is a yield curve. Here is a website to the U.S. Department of the Treasury telling us what the interest rates were at each level of the curve, and we'll talk about that more in a minute, as of Thursday, September 1st, 2022. So what this tells us is how much interest we would earn by lending to the U.S. government over different periods of time. So for example, let's say that you lent the U.S. government $1,000, and then at some period in the future, they're going to pay you the exact same amount of money back. And they're also going to pay you some interest payments along the way. And the Treasury curve basically tells us what you would make at each length of time you would let them borrow your money. So for example, if you lent them money for 1 year, you would make 3.51%. Or on your $1,000, you would get $35.10 in interest plus your original $1,000 back. If you lent them money for 2 years, you would get the exact same interest rate. Now keep in mind, this is annualized, so you would actually get $35.10 each year, or 2 years would be $70.20. And these 1-month maturities are annualized as well. So you're not actually going to get paid, $25.30 in the next month. If you let them use money, you'll be getting this basically divided by 12. If you lend it to them for 2 months, you'll be getting this divided by 6, 3 months divided with this divided by 4, et cetera, et cetera. In most normal times, what happens is the Treasury curve generally slopes upward, meaning that if you lend the government money for longer periods of time, you're going to get a higher interest rate for that money. And that intuitively makes sense. Most people would rather have money today than they would in, say, 30 years. So the reward for letting them use your money for that long of a time period should generally be a higher amount. There's also the potential risk that inflation, as we know, can erode the purchasing power of our dollar. So if you let them use $1,000 for 30 years, it's hard telling how much that $1,000 is really going to get you when you get paid back. There's also risk that something might go wrong. With the US government, that's not really very likely. But if you're lending money to, say, a company for a 30-year time period, there's really no guarantee that company is going to be able to pay you back in 30 years if they're not around, they go bankrupt, or something bad happens to their business. You may never get your money back at all. Whereas if you lend them money for maybe a year or a month, it's a much higher likelihood that you're going to get that money back. But in some cases, the yield curve actually gets inverted. And what that means is that shorter maturities like 3 months or 1 year or 2 years actually pay you more than longer maturities, which intuitively doesn't really make any sense. So why does this inverted yield curve phenomenon happen? Let's say this bar right here represents time. So we've got right now or 0, and then we also have 10 years from now. So let's take a look at the 2-year and 10-year yield curve since that is currently inverted. So the 2-year US Treasury would offer us a 3.51% annual return. So in this situation, let's say we would give the government $1,000. Okay, so we're going to do minus 1,000, meaning you're going to, that's just going out. And then for each year over the next 2 years, you're going to get $35.10. And then in year number 2, you're also going to get your money back. The 10-year treasury, let's say you put $1,000 into that, which is currently yielding 3.26%. So again, here you're going to do $1,000 to the government, and then each year you're going to get paid $32.60. And this is going to happen every single year for the next 10 years. And then ultimately, you're going to get your money back here in year number 10. So if we add up the total amount of money you're going to make or interest you're going to collect on this 10-year loan, over the life of the loan, you would collect roughly $326. On this 2-year loan, what's going to happen is when you get your $1,000 back here in year number 2, you'll be able to reinvest that $1,000. So let's say you could reinvest this $1,000 in 2 years at the same 3.51% rate. Well, if you could do that, you would actually collect $351 worth of interest, which is obviously higher than $326. So why does this happen? If you could lend the government money for 2 years and still make a higher return with theoretically less risk and you get your money back sooner, why would anyone buy a 10-year bond? Why are interest rates on those lower? You would think that people would sell their 10-year bonds and buy 2-year bonds so they get that additional interest. The key assumption that investors in longer bonds are making is that they believe that this reinvestment of this $1,000 when you get paid back in 2 years is not going to be at 3.51%. The market expects that this interest rate, this 2-year interest rate, is going to fall. So that when you get your money back here in year number 2, instead of being able to reinvest that at 3.51%, you're actually going to be able to reinvest that at a lower rate. And in order for this equation to make any sense at all, the market has to be at least expecting the 10-year to produce as much as a 2-year would reinvested 5 times. So basically, the market is expecting that interest rates for this 2-year is going to be 3.19 for the next 8 years here. So instead of getting $35.10, you're only going to reinvest this $1,000 at 3.19. So if you got $31.90 in interest each time for the next 8 years, instead of this $35.10, you would actually collect a total of $326, the exact same amount that you would investing in the 10-year. So you have these $35.10s here, plus this $31.90 8 different times would equal $326. So hopefully that makes sense. Basically, the market expects that short-term interest rates, or this 2-year rate, is going to fall to 3.19% or lower in the future. And since we know the US Federal Reserve is heavily influential in the short-term interest rate market, basically the market is betting that the Fed is going to eventually, in the next couple of years, have to lower the short-term interest rate, meaning that inflation is no longer a problem, and also meaning that the US economy has probably slowed or perhaps even fallen into a recession, making the Fed, instead of raising rates, they're going to lower rates to try to stimulate economic activity rather than trying to pull it back like they are now. And that's why yield curve inversions have historically been associated with recessions. If you go back 50 years, we've actually never had a recession in the US that wasn't preceded by a yield curve inversion. Here's a chart plotting the 10-year minus the 2-year yield. And as we saw recently, that is now negative, so it's below this 0 line. And each time this has happened in the past, it's denoted by these explosions. And then these gray bars represent the recession. So you can see that every time you had one of these explosions, at some point within the next couple of years, you did have a recession basically every single time. So if we look at the US Treasury curve, which of the curves are inverted now? Typically, the critical yield curves that most economists look at are the 3-month yield and the 2-year yield in relation to longer-term yields like the 10-year and the 30-year. According to the Fed, the best predictor of recession has been the 3-month 10-year treasury curve, but a lot of practitioners actually use the 2-year, 10-year curve. When you say that the yield curve is inverted, it's important to know, well, which part of the curve is inverted. And right now, what we can see is that the 3-month curve relative to the 10-year is not inverted. So you have this normal relationship where the 10-year is at 3.26 and the 3-month is at 2.97. The only inversion we really see is when we start to look at the 2-year spread. The 2-year is inverted or higher than the 5-year yield, the 10-year yield, and the 30-year yield. We also see that the 5-year is inverted with the 10-year and the 30-year, but then there's a normal relationship between the 10-year and the 30. So as you can see, there's a lot of different yield curve combinations, and they could be telling us different things at different times. So what is the historical performance of the stock market when different parts of the treasury curve are inverted? This research shows how the S&P 500 did in the months heading before or into an inversion at different types of spread inversions. So right now we saw that the 2-year and the 5-year are inverted, the 2-year and the 10-year are inverted, 2-year and the 30-year are inverted, and the 5 and 10-year are inverted. Everything else is not inverted. So these brackets here kind of represent where we have been so far this year. And this would represent, based on history, what we might expect would happen in the future based on these yield curves. So historically, the stock market has really not done that badly in the months leading up to a yield curve inversion. This year obviously has been different than that, but the average in the past, in the 12 months before a 2-year, 5-year inversion, for example, the market has returned 10.03%, which is actually a little better than the long-term historical average of 9.8%. And again, we see that in the 6 months leading up to an inversion, there's actually better performance than there is on average. But these returns fall significantly in the months after the inversion, which is basically where we're at right now. So the 2-year and 10-year has been inverted for about 2 months. So we're kind of, right here in between these 2 months. And on average, in the 12 months following these inversions that we've seen so far, the market has only returned somewhere between 5.3% and 6.9% on average, which is clearly well below the long-term historical market performance. The only yield curve inversion where you see the 12 months forward returns higher is at this 10 and 30-year inversion mark, where it's basically equal to. Everything else is significantly worse. But you'll also notice on this chart that the worst returns happened after the 3-month turned inverted, which we actually do not see at this point. So I think if you'd see the 3-month get inverted with some of these longer term yields, that would be a worse signal for the stock market. And as we talked about earlier, the Fed's research suggests that the recession odds are higher, more predictive when you look at the 3-month, not necessarily the 2-year. So again, we're not seeing that yet. It's close, but that's something to watch. But when these inversions happen, the average return of the stock market in the next 12 months is pretty paltry, ranging from an average of negative, if you've got the 3-month and the 2-year inverted. And then the best average return is only 2.04% when the 3 and 5-month get inverted. And I'm sorry, actually the 5-year and 10-year are inverted as well. So that's how the market tends to perform after certain types of the curve are inverted. But what if instead of looking at the individual components of the inversion, we instead just simply counted how many parts of the yield curve are inverted? The same research also studied that phenomenon. So when there are no parts of the yield curve that are inverted, the stock market returns basically a little better than its long-term average over the next 12 months, so 10.7% per year. But once you see at least 5 or more inversions, that's when you start getting into below average market performance, except for randomly 6 inversions. So clearly this data is not perfect, but generally the relationship is the more parts of the curve that are inverted, the worse future stock returns tend to get. Right now, we have 5 of these 10 inversions that are met, and most of those are the 2-year part of the curve. So the 2-year, 5-year, 2-year, 10-year, 2-year, 30-year, and the 5-year, 10-year are currently inverted, with the rest not currently inverted. So we are starting to get into this kind of more troubling territory. But just because this past data says something doesn't necessarily mean that's going to happen in the future. So what, if anything, should you do about your portfolio at this time? The first takeaway is that a recession is pretty likely at this point. As we've talked about, the predictive power of the inverted yield curve has generally been pretty good. A Northern Trust research paper showed that on average, when the yield curve inverts, so you're looking at the 10-year, 2-year curve, when that inverts, the number of months you have until an official recession ranges from 6 months to 35 months, or basically an average of 18 months. So if we say that the 10-year, 2-year inverted in July of 2022, that basically suggests you're going to have a recession at some point between December of 2022 and what would that be, June of 2025? And that's the reason I put comma, but ... because just because you're likely to have a recession at some point over the next couple of years isn't exactly a helpful prediction if the recession doesn't occur until 2025. That's not terribly useful information. I mean, it's a little bit useful, but the timing of the recession is the problem. So I don't know that you want to just say, I'm going to dump all my stocks and sit out until the official recession is over. For one thing, the recession may or may not occur at all. If it does, it could be another 3 years from now. And even if it does occur, the market may start to recover, and usually does start to recover when a recession is already kind of going, right, or at its peak. That's usually when the market bottoms in anticipation that the recession is soon going to end and will start another recovery. But still, I think the wise thing to do is pad your emergency fund, and this would be for a couple reasons. The biggest reason being that if you're in a cyclical industry and we do have a recession upcoming and you lose your job or something, it would be very good to have at least 6 to 12 months worth of spending set aside in cash. This might be a good time to kind of revisit where you're at on a financial planning basis. Make sure you're not heavily leveraged. Try to pay off some debt if you can, just kind of in preparation for what could happen. And then the second reason, obviously, is if you have an emergency fund and maybe you build that up and you find a generational buying opportunity in stocks, you're going to have a little bit of extra cash available as dry powder that you can use to invest at attractive prices. While we saw that the forward 12-month return data wasn't as good when a yield curve inverted, keep in mind that an inverted yield curve is not necessarily a death sentence for stocks. This study by Charlie Bolelio showed that an inverted yield curve generally did result in lower than average stock returns over the next 1, 2, 3, and 5 years. However, the returns were still pretty positive. So for example, in the 5 years following a yield curve inversion, the S&P 500 returned an average of 77.7% over that time period. It's 6% lower than the average, which is 83.7%, but still, I think most of us would be okay with a 77.7% return over the next 5 years. Of course, that may or may not happen. But the point here is that just because the curve is inverted right now doesn't necessarily mean 5 years from now you're not going to have a pretty good return on your stock investments. He also looked at the percentage of time the S&P 500 was positive. So on average, over a 5-year period, stocks go up 90% of the time. In the 5 years following a yield curve inversion, stocks go up 81.2% of the time. So your odds of losing money over a 5-year period are a little higher than they are on average, but still an 81% chance of making a positive return over 5 years is pretty good. But still, I think another point to make is pad your emergency fund, and this is not the same as the first emergency fund. This would be if you're, say, a retiree or planning to retire maybe in the next 5 years. It would probably be a good idea to set aside at least maybe 5 years worth of spending that you keep in, short-term bonds or something like, I don't know about cash, maybe something that you know for sure is going to be there when you need it. So again, if you look at this chart and say, okay, I have an 81% chance of making a positive return in 5 years. Well, the question is, what happens if you do end up with a scenario like one of these 20% where you didn't make any money in the stock market in 5 years? Your portfolio of stocks actually went down. Well, you certainly don't want to be spending that money over this time period. So if you keep, say, 5 years or maybe even a little longer in cash or short-term bonds or something, that money you can use to spend for the next 5 years. If the market doesn't generate any returns at all, you won't be eroding your principal. Of course, when you get 5 years out, you're not going to have any bonds or cash left. So then you will have to start digging into principal. But just having at least 5 years can certainly insulate you against a lot of short-term bad news. And then the final point for positioning your portfolio would be to focus on quality value stocks. So quality meaning businesses that have, high returns on equity, high returns on invested capital, strong cash flows, competitive advantage over their peers, low debt loads, and then value, not necessarily in the sense of low PEs, but businesses that you believe are trading less than their intrinsic value. A lot of times those may be stocks with low PE ratios, but other times they may not. You may see value in a stock with a PE of 30 times. If the future cash flows of that business are reliable and growing, it could well be worth the apparent high price tag it's looking like it's trading at. So focus on buying quality stocks that are trading at your estimate of a good value. Those are what you should focus on. In times like this, you should avoid speculative or non-profitable or barely profitable growth companies. Generally, inverted yield curves, not the time to be speculative. Best time to do that would be coming out of a recession when these stocks could really get beat up pretty bad. Could see a lot of value there. But in most cases, the value factor, so this is, I don't love this, but it's generally low PE, low price to sales, low price to book, things like that. But this just in general, this factor has done pretty well according to research affiliates. So the outperformance of the value factor over the last 7 yield curve inversions has generally been positive. So you've seen outperformance over the next 12, 24, and 36 months following a yield curve inversion. So remember, the past does not predict the future, but in the past, you have seen more lower multiple stocks do better than higher multiple stocks following yield curve inversion. So I hope that was helpful for you. Just because we have a yield curve inversion doesn't necessarily mean you should panic, particularly if you're a long-term investor. I don't know anyone who has successfully been able to jump in and out of the market, timing it. I mean, everyone knows the yield curve is inverted. Stocks are down quite a lot to reflect the higher recession odds. So how much does it benefit you selling today? I'm not sure, but it's not necessarily a death sentence for stocks, but there may be some things you should do right now to prepare yourself financially in case the worst happens. So thank you for watching, and I will see you in the next video.